Good afternoon, everybody. It's Greg Schnell. I am here with the final bar. Thanks for taking the time to join me. This is the show where we cover off interesting chart setups to get ready for the next week. Today's agenda, the market gets harder to decipher. We've got this situation where we've got these 5-day flare-ups, vicious reversals, a lot of failing breakouts, and then specifically where Tesla came in this week and crushed the shorts. And on that specific topic, I'm going to cover it off a little bit in more detail right on the Tesla chart. But the point I want to make is a lot of this price action on Tesla is so volatile. It's going to be very difficult for people who are not experienced traders to continue to trade the Tesla chart. Okay, so let me go back here to cover off the S&P 500. One of the things I wanted to point out, this is a 10-day chart here from the beginning of the month. You can just see we've had a big 10-day ramp up on the indexes, and for the last 2 days we've gone sideways on the S&P 500. Looking at the daily chart, that just so happens to coincide right at the highs, and that's making this not more difficult but more interesting, because we want to see how well the market responds to the prior high and if it has the strength and structure to get through. We do see an uptrend on the PPO, but we kind of seem to be limited at this level. Can't get a lot of enthusiasm going to the high side. But there was an interesting point made by Goldman Sachs this week, and the point was that the overall markets are at the place where, with the tax changes, everybody is able to take the money from the tax changes and put it towards share buybacks. And so they're planning on spending $1 trillion on share buybacks. Now, $1 trillion is a huge number. And again, that's going to support most stocks and stop them from pulling back. So even though the market might not have the strength to go a long way up, I think one of the things is it doesn't have the strength, or it doesn't have the weakness to fall. And so we might find ourselves in this whippy market, and I get the feeling that's kind of what's going on as we go through the charts. Now, on here I have one specific chart set up, and I moved it when I was I moved the chart, so let me just go get it, because it's that's not it. This is it. Okay, so what we see on this chart is we have a lot of the index, the S&P 500 running up, but you see this MACD momentum, and it's on the 60-minute chart, it's waning. But see how high the S&P 500 is above its just 100-period 60-minute chart. Well, that's not really a big deal. It compares noticeably with the NASDAQ, quite a bit more compressed towards its 100-period moving average, and the Russell actually sitting very close to its moving average. So when we see these charts all behaving differently, that's one of the things that I'm worried about, is how they're not kind of working together anymore. And here's the TSX, and you can clearly see it's underperforming. Now, if we just, let me scroll up to the top of this chart here, pick more time. What I want to show on here is just looking at the last 2 months. I find this 100-period moving average on the 60-minute to be helpful, and we briefly dipped below here, but quite frankly caught support. And while we had a lower low here, we had a higher low in momentum, and that was a really nice place to get long. Now we have, we still got this upsloping trend line, but the question is, the NASDAQ's not really running away from its trend line or its moving average like the S&P is, and the Russell is barely holding above its. So on the big picture, I think you see the change in the dynamic between the stocks, and you can see the TSX has actually, been sliding for almost 2 or well, almost a month now since it made its high. It was back here on about the 12th of July, and now we're down here. So, well, it's not a huge weakness. It's again, we don't seem to have the strength to really push higher. Now, with the S&P and the buybacks, it's actually working to push the market higher, but I think it might be the reason that the Russell is kind of sitting where it's been for the last 2 months. And the NASDAQ composite, without question, is still in the top corner of the chart. But I think we'd agree that a month ago we were pretty close to this level and hadn't really moved dramatically, considering that's usually the leadership market. But again, with all of the major buybacks, I think that's what's pushing this S&P even more through this period. Okay. Let's go and talk specifically about the different sectors and how they're behaving. And when you pull up this perf chart, it automatically defaults to 200 days, and it usually defaults to line mode. And I find this mode kind of tricky to generate any real information from. You can kind of highlight it and say which one was the best performing group for 200 days. But in histogram mode, I think one of the more interesting things in the last few weeks has been this sudden 5-day surge kind of mentality where the market really runs up and then pulls back. And it's doing it very, very quickly. So in the case of the S&P sectors, so this is sitting here on August the 8th, and the financials are outperforming the S&P 500 slightly. Technology and cyclicals are outperforming the S&P, but the rest of the groups are kind of underperforming the average. Now, if we take the average off and just say what's the absolute performance, so how much have they really gone up, not just relative, consumer discretionary and consumer and technology have clearly done very well. Energy, materials, and industrials have pulled back hard, yet the defensives are actually holding up quite well, and yet financials, which can be partially defensive, but also I'd say in the last 5 years or whatever, has definitely had more of a growth to it, where it seems to move up when the market is very bullish. So just watch what happens as we unwind for, say, 2 or 3 days. And here, all of a sudden, only the defensive side of the chart is doing well, and technology. Just wind back 5 days. Technology was really bad. And consumer staples and healthcare were the only two positive things on the chart as early as August 2nd, or as recently as August 2nd. And then here you were unchanged for 6 days, and technology and cyclicals were the worst. And then again, cyclicals and technology the worst, everything else the best. And we'll just watch what happens really quick here. So energy was one of the top performing, and then if we just go forward 5 days, within 5 days it was the worst. So you're just seeing these wild swings where this is energy was down 1.73, and 3 days before it was up 3.62. That's a 5% swing in a week for a reasonably sized group. And just watching that kind of swing, and it's been like that lately, where lots of things are swinging wildly, and we're not getting the sort of kind of continuous movement where something kind of gets in favor and is being pulled up for 3 weeks or a month or 2 months or whatever. We're just not seeing that sort of continuous rhythm. So I think it makes the market trickier here to analyze. And if your portfolio is not hitting new highs with the S&P, or if your portfolio had kind of made new highs earlier in the spring, let's say either January or May or something like that, it's this chop in here that's making it hard. I've talked to some pretty experienced technical analysts, and they're watching energy, and what you see on energy is it's doing pretty well, and then all of a sudden it's just falling apart. When that happens, you're going off and you're buying the energy stocks that are correlating with that. And the problem is, in doing that, as you do it, they're breaking out to new highs. And then crude does a quick pullback, and all of a sudden, you're down 10% because these stocks have moved so quickly. So if I use the example of BHP Billiton. And the reason I do this is it broke out to a new high, so it was in the material sector, which hasn't been one of the leaders. But you see this horizontal level that it tried to break through, and then it quickly gaps down the next day, gaps down the next day. And this is an ADR, so an American Depository Receipt, because it's traded primarily in Australia. But what you see here is if all of the material stocks are going to do well, you kind of need to be aware of what the other ones are doing. So here's Rio, also traded in Australia, but it made its highs way back in June, and it's actually below its 200-day moving average, so it's really pulling back hard. If we take FCX, which is copper and gold, whoops, let's just go back a chart here. FCX. What we see on this particular chart is it's been declining since January and hasn't been able to break out to new highs. And if we go to Teck Resources, which is a Canadian company, you know, we're getting this bifurcation. Now, if we go to Goldman Sachs, you know, it's below its 200-day moving average. But if we go to JP Morgan, you know, it's breaking out to new highs. So my point is that, you know, even the big, great companies are all over the map. And so if you happen to be in the right ones, great. But don't be surprised if all of a sudden your portfolio is not keeping up with the index, because it really is a mixed bag. And you can take any 5 names of the leadership group, and their charts are all different. So here's Wells Fargo, clearly up from April, and yet some of the other ones are down in the bottom right-hand corner. Okay, the second thing I want to cover off is when we look at the markets, I think it's important to be aware of the advanced decline lines and stuff like that. And one of the reasons I think it's also hard here, it was interesting, I'm getting ready for ChartCon 2018, and if you haven't registered, I'm going to show you how to do that. Actually, let's show you how to do that right now, just to make sure. But just go to stockcharts.com/ChartCon and take a look at all of these speakers. But I think there's a considerable value showing up to present here. Barton Pring is just arriving this afternoon. Alexander Elder, I think his book, Come Into My Trading Room, is probably one of the more interesting reads and really a helpful book to teach people about market psychology and where value is and selling at an extreme, and don't worry if you miss the top and all that kind of stuff. I find that a compelling book. Tom McClellan looks at the market with way more variety than a lot of the others do, lots of typical indicators and that kind of thing. I find his narrative quite unique, and some correlations may seem hard for him to use, you know, just because of the breadth of correlations and things that he looks at that are working together. He has a pretty clear picture on the market, so I think he's great. David Keller, of course, former CMT Association president, brilliant guy. Tushar Shande, you know, he's published a book. Greg Morris has published a book. Arthur, I mean, a lot of these guys have published work. Gaddis Rose, Bruce Fazer with Wyckoff, Mary Ellen McGonigal, a lot of the breakout buying stuff. So anyway, if you haven't registered, I think it's a crazy good deal for $249 to hear these guys speak or hear these people speak. Greg Morris, his book is fantastic on breadth. He'll give you some really nice clues. Okay, and it was his thought that made me come here. So let's get back over to breadth. But the point I want to make on breadth is some of these indicators work a lot better than others. And Arthur Hill and I were chatting today about, he had done a specific recording on breadth, and he used a whole bunch of breadth indicators that I don't even look at, and conversely, the breadth indicators I look at, he doesn't use. So it really, I would encourage you to look at both presentations. And when Arthur covers off his, he uses a lot of up down percentages, advanced decline percentages, that kind of thing. I'd encourage you to just listen to them both, and then try and find the ones that fit your eye and help you more with the market. Okay, one of the things I wanted to make the point about the NASDAQ advanced decline line was, here is a case where the advanced decline line is falling for 6 weeks, yet the market continues to go higher. And when you have that, it makes it much more difficult to trust this chart. Now, if I compare that with the New York advanced decline line, I don't see that same sort of thing. Basically, when the advanced decline line is falling, so is the market. And it's not like it kind of helps me, there was not much for clues in helping you find the top in this market where this peaked out the same time that peaked out. Recently, we've been going almost flat on the advanced decline line for the New York Composite, and I mentioned it last week as well. So this line is flat, yet the market has gone up for almost a month. I wouldn't say this indicator's not helping, but I would say that I'll call it, while this indicator's barely going up, that's kind of the strength within the market, not much. So the market's still able to go higher, but it's really not kind of I'll call it the high correlation that we might see in a regular advance. So that's one of the reasons I would share caution with the current state of the market breadth, is that, this is barely higher, if at all, and then yet the market is higher over the last 6 weeks or whatever. If you take a moving average at the advanced decline line, we're sitting in an okay area, but really the market gets a lot more power when we have 200, 300, 400 advancers compared to decliners. And we're just not seeing that level of difference. And so the market's kind of middling along with a little bit of an upward bias, but not a huge one. So just be aware of that. Okay, on the NASDAQ high lows, I don't find the same thing. I find that information helps, and it's pretty similar. It works as good as it does on the New York. So it's really the advanced decline line for the NASDAQ that I find weaker. But without a question mark, this is a bullet trend higher on the NASDAQ. But lately, over the last 2 months, we've had lower highs for net new highs, and recently, we're dipping down to this minus 100 level, but we just can't seem to kind of get this big overall thrust going. And I made some notes back here, periods where we kind of had 2 months go by where we had declining highs, and you can usually see that it creates, more of a significant drop. We haven't really seen that yet. So I'm a little bit worried that perhaps one of those is about to start showing up, and even not necessarily a major pullback, but more something that, this tight uptrend we've got across our lows starts to get discontinued. Okay, let's go look at the New York high-low. And the reason I want to keep covering this one off is just as the market changes, hopefully as we're going forward on the final bar here, and I show you this often enough, you'll get a feel for how I use it, and hopefully that'll help you use it to help spot market weakness. So here we have the high-low with a 8-period moving average, and you can just see in general we've kind of got a downtrend on the highs, even if I picked mid-July highs instead of the 1st of June highs. You can see we're still underperforming where we were, so we've got less new highs, but we've got a higher market. And again, we just don't have this breakout on the high lows where we have a big bullish thrust. So I think part of it is this buyback is helping the market move higher, but we don't have the uniformity that we would normally have in a big bullish push where a lot of things start to work together to take the market higher. So this rise is considerably different than this rise, because in this case we have a lot of new stocks, a lot of stocks making highs, and we have a wider breadth of stocks making highs. But in the current case, we're not seeing that, and it's almost like on different days a different stock is making highs, and then they sharply pull back, much like I showed you on the BHP chart. And so you get that kind of breakout and then a whipsaw back. I, so if I look at some of the oil stocks, oil last week was looking pretty good, and then all of a sudden it falls apart. So I should just go right to a different chart here. So here's Encana, and it breaks out just barely, right? 1427, here's 1428, pushes above, immediately comes back, and now it's down, from 1428, its low today was 1337. It's given up, 5% or something in almost $1 on 1428. So about 5% in a couple of days. And that's just after hitting a new 52-week high. And it continues to try and do this. Here it gets up, tests the high, doesn't quite make it through, and then falls all the way right back down to the 200-day moving average in a couple of weeks. So it's this erratic, static push and pull where the market isn't really thrusting higher, it's kind of grinding higher. So as we continue to work our way through summer, what I'm hoping to see is a big expansion in breadth. Now, I do have one other chart in here. Let me just go get it. On these, oops, I grabbed the wrong one. Sorry about that. On the bullish percent index for the S&P 500, it is behaving much more bullishly than, say, the New York Composite or the NASDAQ Composite. What you see here is we're well above my kind of 65 line for the percentage of stocks above the 200-day. That says there's lots of stocks. 2/3 of the stocks are above their 200-day moving average, pushing higher. That's plenty bullish. On the actual level that I've picked for the S&P 500, I picked 65%. We're above 65%. We're at 68%. That's extremely bullish. So 2/3 are on a buy signal, 2/3 are above their 200-day moving average, and yet the market is grinding higher because of this kind of whipsaw. So hopefully you're able to find the best stocks to be in, but I will be the first one to say it's very hard right here. Okay, let's go and look at Tesla. And on Tesla, the point I want to make here is, this chart has moved $100 in 7 days or something like that. And 386, 389, and we're 387 this week. So it moved right to the top of the range. And when the tweet came out on Tuesday that he had secured Elon Musk said he had secured funding for doing a private buyout of Tesla at 420. The market didn't go to 420, but it did go up to test the prior highs. And recently on my Twitter feed, one of the things that came across was that there was a good book written about compelling CEOs. And what it talked about is, there's Steve Jobs, who is a pretty compelling speaker. I would argue Satya Nadella is a pretty compelling speaker. Elon Musk is a pretty compelling speaker. But we also had people from WorldCom and Enron that were compelling speakers. And the differences between the companies was how they manage their financial situation. And I think one of the issues with Tesla is that his growth ambitions exceeds the financial width of the company. And so when you get that sudden the shortfall in capital to do what he wants to do, and I would be the first to agree, he's a very brilliant man in terms of car technology and in terms of marketing and all that kind of stuff. It just seems like the company, when you're having a $100 move in a few days on a stock, this is not a stock for a basic investor to own, because it can be 100 both ways. Here it was 386, and within 10 days or whatever, it was 303, so a $70 move down. Just be careful if you're in Tesla that its position size is very small in your portfolio, because these whips can go both ways. And again, not comparing him to Enron, but in terms of financial stuff, there, Tesla has a very difficult case for its financial capacity to pull off the plan as laid out by Elon Musk. Now, it might work out, but it's definitely shouldn't be a majority of your portfolio, because it really is the type of stock that can go both ways. And the other side of that argument is, when you see volume spikes like this, they are usually major inflection points. They can either be at lows or be at highs. But in both cases, when you see volume spikes, that is typically on a chart, it's at a major inflection point. It's either a capitulation low or a capitulation high. So I want to point that out, because a lot of people ignore the volume line, and it could be very helpful in pointing out where trouble might be hiding. And just, to pick random events, I mean, you could literally go to every chart, and here's Twitter, and let's just go. So here's volume, sure enough, shoots up, and the chart doesn't do anything for a couple of weeks and ends up pulling back from that level quite significantly, 35 to 26. Going over here to this volume breakout, it was the chart just breaking out to new highs, and then it went on for another 20% above that. It's that kind of thing that the volume is an important place to look for those clusters and to be aware of the change in tone in the stock in terms of investor behavior through the volume bar. And I think some of the best work by that on volume is a presentation I watched by a guy by the name of Ralph Vince. He's written 5 books, brilliant man, mathematician, but he is constantly on the alert for extreme high volume or extreme low volume, where a stock makes a new 52-week low volume, not on a holiday week, not on a vacation period or something like that, where even midsummer he'll have extremely low volume, 52-week low, and he'll mark that on the chart and just be aware of the change. So I think there's a temperature gauge on Tesla, and it's running pretty hot right now. And if you're an investor with big hopes for the company, I fully get it. He's a compelling CEO, but use the volume to help you help your sentiment reading. And if you're getting as emotionally moved as the chart is, it's probably too big a position. So be careful with that. Lastly, the only other thing that I think is going on this week that is more difficult, we're coming into options expiration again. And when you see the options expiration week coming up, usually we get a couple of run-up days to it. We're after earnings, so I was actually expecting the market to pull back after earnings, and I think Goldman Sachs put out a pretty good reason for the market to not pull back, which was the share buybacks. But on the small caps or whatever, you might not see that same level of buybacks. They might be trying to grow their companies a lot more. So with the change between the groups, so the Dow Jones Industrial Average, the S&P 500, the S&P 100, NASDAQ 100, the Russell 2000, all of those groups kind of have tops in different places on the charts. And I think it's telling us that the market is struggling to figure out where the leadership is going to come from. And that perf chart where I showed things were kind of changing faster than we were expecting, all of that together as a bundle, I think it makes the market harder to trade here. So try to stick with your winners, but don't be stubborn, and try not to get whipped out too quick either. So position size is probably the biggest clue. Thanks for taking the time to join me on this week's Final Bar. You can catch more copies or past versions on YouTube and also on the Stock Charts TV channel. We have some previously recorded shows on there. So thanks everybody for joining me. Bye-bye.